Good morning, depending on where you're joining us from. It is my pleasure to welcome you to today's live show. We're going to be talking about leveraging the share market. If you can hear me, can you please say g'day in the chat? I can see a few folks. Trent is from Gleedswood. Gleedswood, is that how we say it? You're gonna correct me on that, Trent. Gleedswood Hills in Sydney. Caroline, good to see you back. Owen, great name, easily the best name on today's chat, I can tell you what, from Bunbury. Loving to see you dialing in, mate, so thank you for that. So today we're going to be joined by two great co-hosts with me today. So g'day Hayden, g'day Sharish, everyone, wonderful, thank you for that. Okay, so we're going to have a combination. We're going to answer a lot of questions. We're going to hear about the new geared range of ETFs from Betashares, which I know that there were questions about on our podcasts and across the Rask community over the last few weeks. There's been a lot of commentary about these. So we'll dive into those with Cameron. And then we'll say goodbye to him and we'll welcome Alex Luck, financial advisor, to the show, who many of you will know, Alex, from Everest Wealth. So he'll be joining us to answer the advisor questions. But as I can see, everyone's already starting to do. Nick, Justin, Paul, even Betashares themselves saying g'day. Lots of content over on the Betashares YouTube channel, by the way, so don't forget to hit subscribe over there. As you can see, lots of questions coming in. Paul, see? Question, love it. Keep them flying in, guys. We will have time for questions with the crew. I am going to bring up my screen if I can, just quickly. There we go. Here we go. So we've got a webinar. We're going to go for about 60 minutes or so. If you haven't already subscribed to the YouTube channel, don't forget to hit subscribe. That's that big button that says subscribe just next to the video. YouTube is really kicking off lately. Now, in traditional form, normally what happens on a Rask network like this, we would do a joke. So I did steal the good Dr. Andrew Dermot's Dad Jokes book just a moment ago while I was in the studio. And I thought, I've got a bit of time. Why don't I kind of go through it and find a joke? So here's one for today. To the person who stole my Microsoft Office, I will find you. You have my word. That's the dad joke for today. You can give me a score out of 10 if you really want to. So leveraging the share market, you will be joined by myself, obviously, Alex and Cameron in the reverse order, actually. And we are going to be talking about something today which I really want to make very crystal clear. We're talking about investing. We may be answering some questions. It's really important that you get the advice of a licensed and trusted financial planner or financial advisor, which you can verify on the moneysmart.gov.au website before acting on any of the information that you hear today. We are limited to general financial advice only. That means any of the questions or commentary that we give today is strictly general and does not take into account your needs, goals, or objectives. So please do not act on it until you have spoken to that financial planner. And we are going to talk about ETFs. So make sure you head to the Betashares website where you will find the product disclosure statement or PDS and the TMD of each of the funds that we refer to. Final note, and you'll see the disclaimer down the bottom here as well. I want to make a special note of the last couple of sentences here. Gearing magnifies gains and losses and may not be a suitable strategy for all investors. Geared investments involve significantly higher risk than non-geared investments. Now, we're going to explain what that means when we welcome Cameron to the show in just a moment. In fact, why don't we do it now? We're joined by Cameron Gleeson from Sydney. How you going, mate?
Good, Owen. How are you?
Very good, mate. It's always a good chat with you. So my first question to you, mate, while we wait for everyone to line up with their questions, is what was the first ETF that you bought?
Yeah, so a very long time ago, I bought an ETF by the ticker code IVV. That was my first ETF purchase some time ago before I started working at Betashares, in fact. So probably, I'm going to guess that might have been around about 2010. So that's actually worked quite well for me. It's probably one of my better single trades, having held it over that period of time. But that was the number one in the portfolio.
Mate, I like it. You've got to start somewhere, and why not? Now, you've got a few slides that you have prepared for us today, so I will bring these up. And folks, if you do have questions for Cameron or for Alex, please jump them in the chat right now, because he's going to go through these slides. We're going to talk about some of the products, and I know many of you have already sent in questions. Keep them coming. Get a 12 out of 10 for that dad joke there. That's fantastic. Thank you, Caroline. Okay. Cameron, I'm going to hand the reins over to you, mate, and I can see the slides up on screen now.
Thank you, Owen. So as you've already sort of introduced, I'm going to really talk a little bit about some new funds that we've just brought to market a little over a week ago, which is our new Betashares Wealth Builder range, and 2 fund ticker codes there shown there on screen. Owen's already mentioned this, but general information only. Please seek financial advice. And just to start off with, I thought it was really important just to give an overview as to what we mean when we talk about gearing, because these wealth builder funds employ the use of gearing to invest in the equity market. Now, a lot of Australians will already be very familiar with the use of gearing to invest in, for example, the property market. I mean, most Australians have to apply for a mortgage in order to afford a property these days. But here's a sort of a mathematical example to sort of look at what the basics of a gearing strategy look like. And so on the left-hand side of the chart, we see an investor who is looking to invest, and they have capital, say $100 that they want to invest, but they don't just want to use their own capital. They want to borrow money. And a way that someone might do that is they may apply for a margin loan if they were to invest in the equity market or the share market. Or if they were going to buy a property, they might use an investment property loan. And so for this particular case, we've got an investor with $100 of their own capital. They're borrowing $66 of capital to give them a total pool of investable capital into the market of $166. So, that's great. That gets you a greater amount of exposure to the market than you could afford with your $100 alone. The scenarios shown on the right-hand side there point out the repercussions of that on a daily basis. So, for example, if the market had then subsequently gone up by 10% that day, then you would expect the geared exposure to go up by around about 16%. So that LVR of 44% translates to an exposure to up and down movements of around about 166%. So there's sort of that relationship between the amount you borrow and the exposure you get. So obviously magnifying both gains and losses, scenario 2 showing a loss. Now, that's not all there is to it with regard to gearing. You've also got to take into account things like the interest cost, maybe the compounding of gains over time, as well as any rebalancing effects, costs and franking credits. So there's a bit more to it, but that's at least a simple overview as to how gearing is used just more broadly. Now on screen here, I'll show the 2 funds that we've just brought to market. So the column in the middle there is our Betashares Wealth Builder Australia 200 geared complex ETF. Now, this fund is very much based on our very popular A200 fund. The ticker code for this fund is G200. You can see in the second line. It's the 200 largest companies in Australia. But rather than just investing dollar for dollar for every dollar of investor capital, we put a dollar work into the market. We're employing leverage, or we're using borrowing. So the way this fund works is the fund itself borrows money, and the amount of money it borrows is a loan to value ratio of between 30 to 40%, and then goes out and buys that amount of equities in the Australian equity market to give you that really broad, diversified Australian equity exposure. The second fund that we show in the final column there is the Betashares Wealth Builder Diversified All Growth Geared Complex ETF, GHHF. These funds have complex in the name due to asset requirements. They are geared funds, so that's an important requirement that the complex remains there in the name. But that second fund is really giving you that very much diversified exposure. You might be familiar with DHHF, which is an all-growth diversified exposure to both Australian and global equities. This is very much the same type of exposure. Both of these funds do one really important thing when it comes to using gearing to invest in the equity market, is they give you very diversified exposure. Now, that can be really important to ensure that you are taking advantage of diversification, to ensure that while taking on gearing, you're not introducing, a level of volatility beyond what you can tolerate. Because obviously having diversified exposure means you get the benefit of stocks within that overall mix moving in opposite directions and lowering that volatility. So taking a diversified approach to gearing, we think is really, really important. But the other really interesting thing about these funds is that we've got a long history in terms of innovating on the ASX. We launched the first geared funds available in 2015. These are what we call moderately geared funds. So rather than having, for example, a loan to value ratio of say, 50% or more, these have what we describe as a much lower, level of gearing. And that's important for an investor who's looking to have a more of a buy and hold investment style. It's going to lower your overall volatility, and it means perhaps you can spend less time watching your investment because it's not going to move to the same degree a more highly geared fund would. And that's where we think these funds have a lot of applicability. It's really the use of that moderate level of gearing to build wealth over time, where these funds really do, I think, have a position in certain clients or certain investors' portfolios. It's that way to build wealth over time, particularly when you've only got a limited amount of capital to start with. There's some key benefits to the way these funds are structured. Rather than if you were to invest using, say, for example, a margin loan, where you have to make a loan application, you have to do a credit check, you have to go through a whole number of processes, and it can be quite sort of expensive to borrow money in your own name. These funds are what's known as internally geared, which means that I can just buy units in the fund on the ASX, and that gearing is all taken care of by the fund itself. As a result of that, it's not you borrowing money from a bank, it's Betashares on your behalf borrowing money within the fund. And a real advantage of that is that Betashares is able to access very competitive rates or interest rates when we are borrowing in the institutional market. So the rates at which this fund borrows is far lower than what you would get from, for example, a margin loan or other equivalent investment loans. It's a really effective way to get cheap access to capital to leverage up your exposure, and that's really important to ensure that you're going to have more likely have a good outcome, because you need to be able to outperform, and you need the market to essentially perform to give you a return higher than your cost of funding in order for a geared exposure to outperform the non-geared exposure. So we think that's really important. And finally, of course, one of the other great things is if you're an Australian investor and you're eligible for franking credits, when you have geared exposure to Australian equities, not only do you get the regular amount of franking credits someone would assume, you also get additional franking credits versus the ungeared investor. So some clear benefits there, and we think that these funds have wide applicability. I'll just call on a couple of different, if you like, scenarios or particular use cases for the wealth builder funds. But before doing that, I should say that the key to investing in any moderately geared or highly geared exposure is you do need to have a degree of tolerance for a slightly higher level of volatility than an ungeared fund, even for these what we call moderately geared funds. You also should have a view that markets are going to generally, not all the time, but generally appreciate over time. So they're important characteristics or important, perspectives that you as an investor must hold. But looking through here, we've got 4 different case studies for why you might look to invest in one of these wealth builder funds. And the first is really about that wealth accumulation process. We know that a lot of young investors, when they're starting out, don't necessarily have a lot of capital to play with. And when you're trying to build your wealth over time, it can be really hard to access the compounding power of the markets when you're only able to say, for example, save up $1,000 a month or even less. These wealth builder funds allow you a way to get more exposure sooner, and that what we call a dollar cost averaging approach, by putting whatever you have available consistently into the market over time, no matter whether the market's going up or going down, might be a good strategy for building long-term wealth. And the power of leverage in order to accelerate that wealth journey can be really important. And then there's other use cases. So for example, if I have a mortgage, if I'm already sitting with a mortgage for a house that I live in, that will be non-deductible debt. I might also have a share portfolio that sits alongside that. I might still hold equities. Well, one way I might use a wealth builder fund would be to basically sell down my non-leverage equities, invest in a wealth builder fund and release capital. So hold the same exposure to equities, but release some of that capital in order to pay down my non-deductible debt. And then, of course, I talk a little bit about franking credits, the benefits of franking credits. We all know that, investors that hold, say, for example, an SMSF franking credits can be really important in terms of the overall picture for returns. But within SMSFs, there's various use cases for gearing, and indeed these moderately geared strategies I think are quite well suited for the SMSF, provided within your trustee as such an internally geared fund is an acceptable investment within the realms of which you're allowed to invest. But you can use a moderately geared fund to effectively increase the amount of exposure you can get to the market in those early years, where we've got, for example, a cap on our concessional contributions of next year it will be $30,000. You can use moderately geared funds to increase that exposure to up to $45,000. And then we can also use moderately geared funds at different stages of the SMSF life cycle through to managing an SMSF, which is indeed quite large and optimizing across structures. And finally, in pension phase 2, there's also opportunities to use a moderately geared fund to look for ways to perhaps even optimize your pension together with other investment products. So there's a lot in there. We've covered I think just briefly some use cases in quite briefly there, but please see our website. We've got more details in terms of some of these strategies. I'll hand it back to Owen.
Thanks, mate. That was very comprehensive. We did actually have one fantastic question, which I think you'll have answered quite a few times already. And for anyone that's not watching on YouTube, this is from Rex. I'll just bring it up on the screen here. How does the G200 differ from, say, the Gear ETF, which I'm showing here on the screen? How does it differ, mate?
Yeah, that's great. So I don't know, we might be able to do this live. If you can scroll down there, Owen, just a little bit more, it'll show the gearing range. Just if you go a tiny bit there. Yeah, so can you see, if you see the gearing range there within Gear, that's Gear, that's a more highly geared fund, so between 50 and 65%.
Mm-hmm.
Now, I mentioned G200. It has an LVR of between 30 and 40%. So the way that G200 works is that it will have a loan to value ratio between that range, and every day that loan to value range will change slightly. At the end of the day, if the LVR moves outside of that range, it will rebalance back to the midpoint. Gear works exactly the same, but the gearing is substantially higher. So between 50 and 65% LVR means you have a much greater degree of exposure to the market. And that means you're going to obviously, participate, more strongly in upside runs, but also you'll see, the potential for, erosion of capital in a downside scenario. So where I see Gear as something which is really useful is if you want to express a really strong view on the markets and where you're prepared to really watch how that investment's going over time. Whereas I believe that, for certain investors who have that degree of risk tolerance to have gearing, the moderately geared exposure is something which can be more of a, less hands-on investment experience and look to build wealth, accumulate wealth over time.
I did have the fortune of being able to sit down with you the other day in a podcast that hasn't yet gone to air. And one of the questions that I had for you, because I know it's a question you're getting a lot, and Trung has asked a similar question here, which is like the current interest rates. Can you give us any indication? I know it's not always possible to be precise, but just generally speaking, what it might be comparable to.
Yeah. So look, we obviously want to deliver the best possible outcome for investors. And as I mentioned before, we're able to access institutional markets and get, really effective rates of funding for this fund, which is I think a really important thing to be looking for when you're using any kind of gearing. Unfortunately, because those rates are very attractive, we're subject to a confidentiality agreement. We're not able to disclose what the rates are. But if you were to look at, say, for example, a margin loan, or indeed, most investment loans to buy property, I think you'll find that the rates of funding that these funds actually, access or pay are lower than those sort of figures. So, that'll bear out in the long term. We'll see the performance over time, and you'll get the benefit of that lower rate of funding. Unfortunately, I'm not able to disclose what the rates are, though.
Oh, that makes sense. And we know that they would be commercial if you're borrowing in the institutional market, for those folks that aren't aware. If only that we could do that as mere mortals. So there was another question that came through from Rex very early on in the podcast. Thank you, Rex, for the webinar, I should say. Thank you for sending this in. Rex says something to the effect of, which is also touched on by Lemon's quote. Question which came through a bit later, which was, I've been in geared managed funds for around 25 years and made good returns. Recently, some geared ETFs seem to have come with higher volatility, but do not exceed the market return. Why is that?
Yeah, good question. Well, when we think about any kind of geared investment, it's not just a matter of, let's just say, the moderately geared funds, on average on a daily basis, we expect they should give you, and it's sort of a little bit, can vary a little bit either side, but around about 1.5 times the exposure to the equity market. Now, if we say the equity market is going up, then that should mean that we are outperforming. But what you also have to take into account is the costs associated with gearing. And this doesn't just, I'm not just talking about our funds here, but any geared strategy. That interest cost is a hurdle by which the fund itself or the underlying exposure the fund's seeking must outperform. So, I'm not sure what actual investments Rex talking about, but if the interest cost for those funds is indeed higher than what the market's returned over a certain period, that's going to be a bit of a hurdle. And then the other thing we can sometimes see is that if a fund is more highly geared, so for example, gear is one of our funds, we can see some rebalancing, and if that happens at an opportune time, that can also influence the longer term outcomes. Now, the great thing about the moderately geared funds is the range, or the level of exposure, is a little bit more consistent than the more highly geared funds. So while we do expect to see some variations over time, we think that it'll provide a relatively consistent outcome. But there are some reasons. They're really just, what is the interest cost? Because that's my hurdle. And what happens to that fund based on the rebalancing that it undergoes over the cycle?
One final question I'll ask you, and then we'll say good afternoon to you, sir, is more so around why. I've got the chart up here in front of me, and anyone can search on the BetaShares website. They can go GHF, for example. Why did BetaShares choose to launch with these two underlying strategies? So you mentioned like DHHF or A200 as kind of inspired type of products, and these have the gearing to go with it. Why those two in particular?
Yeah, well, I think a really good use case for these funds are investors who are often just starting out on their investment journey, and we've seen really good support for those two ungeared funds. You mentioned DHHF, which is a diversified all equities fund, sort of a solution where you can get an entire equity portfolio in a single trade, diversified across countries and sectors. And A200 is that low cost diversified Australian equity exposure. So for investors that are starting out, that don't have a lot of capital, that's often the first place where we see people buy, and they're very popular funds as a result of that. And so for the sort of younger accumulator who might be starting on that wealth journey, we think they're really applicable. But also having that the real diversified exposure, we think is critical to any geared solution. I mean, if you went back to the GFC, for example, where we saw a lot of investors take out a margin loan to buy individual shares, individual shares can see pretty significant price drops. And while these funds are internally geared, so you're never basically going to be on the hook. You're never going to be in a negative equity position. For a margin loan, we actually saw people, banks chasing people for money as a result of individual shares falling below the loan value. And so that's where you want to think about the use of diversification and what that brings to the table for a geared solution, and hence the use of that broadly diversified Australian equity solution, which also you get good franking credits out of, and then also the that all global and Australia exposure is a simple solution just for all your equity needs.
Great. Well, Cameron, just conscious of time, I really do appreciate you dialing in today and sharing some of your thoughts with us. We do have the website available in the show notes or below the video on YouTube. If you do want to download the PDFs, have a look at the TMD and all of the constructs. There's also some articles on the BetaShares website that explain some of the questions that we've received in the chat that we haven't had time to get to. You will be able to get a lot of those answers on the BetaShares website. So, mate, once again, Thanks for dialing in, and enjoy the day in Sydney.
Great, Owen. Thank you.
Cheers. So that was Cameron Gleeson from Betashares. Now, I know we haven't got to all questions, and in particular, some questions around things like debt recycling and these types of topics. A wonderful guest and profession to call into the show would be a financial advisor. Unfortunately, we have one standing by. So I will call for more questions. I can see James asked a question before, plenty of good questions from Josh. One of the things that I will call out as we move through today's segment is just one thing, is when you do send your questions in, please be mindful that we can only give general financial advice. Even though we're about to welcome a financial planner onto the show who can give personalized advice, it has to go through a particular process before you can get that. So when you do ask your question, be nice and creative. Don't give us a lot of personal information or situational type stuff. Let's keep it investing focused or personal finance focused. Okay, now we'll welcome to the show Alex Luck. Alex from Everest Wealth. How you going, mate?
Good, mate. How are you?
Good, mate. I'm very good. And I'd say good morning to you because you're coming to us from Perth.
Yeah, almost good afternoon, getting close.
Almost there, mate. So thank you for getting up so early. But I do really appreciate it, mate. People will know that you're a regular on the Rask network, coming on and answering lots and lots of questions. So hopefully we have quite a few here today. First one from me, same one I asked to Cameron, is what was the first ETF you invested in?
Yeah, I was. I can't fully remember, to be honest, but I'm pretty sure it was VDHG, the Vanguard Diversified High Growth Fund, which is similar to DHHF, I think, is the Betashares version. So I'm pretty sure that's what I bought first up. But then I do recall also buying an Indian stock market ETF as well, pretty soon after that. I can't remember why I did that, but it's worked out to be pretty good so far, long term.
So that's good to know. I thought maybe that might have been inspired by a trip to India or something like that.
No, I'm pretty sure it was just talking to someone randomly one day, and they were saying that they reckon the Indian stock market's going to be good, and that was probably like 7 years ago now.
Oh, wow. Hopefully you held on to it. Okay, mate. So for folks that haven't heard from you or heard of you before, so Alex does appear regularly on the shows, not just the Rask Network, but also other podcasts and that type of a thing. Can you give us just a quick, overview of yourself and also the Everest business, just to add some context for the types of questions that people should be asking you?
Yeah, perfect. So my name's Alex. I'm from Everest Wealth. So we're a financial advice firm based here in Australia, helping clients Australia-wide. So we've got so HQ's based over here in WA. However, we do have staff in every single state now as well, including other advisors. So we pitch ourselves as Australia-wide. From that perspective, we predominantly help accumulators, so sort of people aged between sort of 25 to 50 is the main sort of space that we typically play in. So, and a lot of that is kind of people who are experiencing financial advice for the first time, or they've potentially done a bit of their own thing and now they want a bit of a sense check or a little bit more guidance or something like that. But yeah, that's pretty much the space that we predominantly play in.
Yeah, great. When I was chatting to the team at Betashares and they said to me, hey, we're going to talk about, we'd love to talk about these types of funds and whatever. I sent you a text message and said, hey, would you be interested in coming on and being part of the webinar? And you're like, well, turns out I was kind of looking at them anyway. So this kind of makes a lot of sense.
Yeah, that's right. Yeah, obviously we get they send out this stuff. Yeah, generally we get access to it a little bit quicker in terms of what they're going to do. But yeah, this is something that we do deal with day to day, largely for our clients as well.
Yeah, particularly the use of not just ETFs, which I'm going to ask you about in a minute, but also the use of gearing or leverage in someone's broader financial picture. We've had a lot of questions about this already coming through. So quickly, it might seem obvious to everyone else that I'm asking this question, but this is actually a really important question to ask your financial advisor. So if you do see Alex or another financial advisor, ask them this question. Do you use ETFs in your clients' investment strategies, and do you use them often?
Yep, so we do. We use them all the time. We often use them more often than a direct share purchase these days as well. So yeah, predominantly we build our portfolios around ETFs. Another good question actually is probably to ask your financial advisor is about the approved product list. Okay, so a financial advisor can obviously provide you financial advice, but then they're limited to what products they can talk to based on that list as well. So we have what's called an open APL, so we can effectively provide advice usually on anything, provided it's backed by some form of research. I.e., for example, we can use the full suite of the Betashares products.
Yeah. So APL approved product list. It's basically what the compliance overlords tell financial advisors they can give advice on or recommend. But in this case, it's open, which is great. Okay. So in terms of long-term growth, and we're building up to these gearing type questions, which I know everyone else wants to chat about. And Suresh, there's a good question there from you. So I'll come back to that in just a moment. Are ETFs, in your opinion, a good way to not just invest for income, which we've covered before, but invest for long-term growth?
Yeah, absolutely. They're a great way to invest for long-term wealth. They're a structure which typically will provide you access to tens or hundreds or thousands of companies with one sort of trade as well. So you get that diversification mix. And diversification, I think, always works in both ways. A lot of people are aware of, I guess, how it can potentially reduce your risk, right? But it also means that then you're not potentially missing out on other opportunities as well. So if we're just investing in Australia as an example, the share market here only makes up about 2 to 3% sort of worldwide. So if you're just doing that, think about how much you're missing out elsewhere as well.
Given that you deal with a lot of people in their 20s, 30s, 40s, 50s even, my question before I throw it over to the audience that's joining me here today is, how often do you use any type of, say, like debt-based strategy to invest? So we often hear about things like good debt, bad debt. And I'm of the opinion that if debt is used sensibly, it can be used for long-term investing, provided there are a few criteria, of course, with the person mostly, risk profile, their behavior, their investing knowledge, all those things, their income. If you use gearing type strategies, not necessarily just like the Betashares ones that we're talking about, but people were talking about debt recycling, all that stuff, just as a general kind of gist, is it common for you to deal with that and to get clients asking you about that?
Yeah, it's relatively common. I mean, it's hard to put it down to how many times we would do it, or 10 clients walk through the door, how many we would do it for, because it really is a sort of case by case situation. But it is something that we are regularly talking about with clients, regularly getting asked about, and we'll use and have used any combination of, say, a geared ETF or more of a debt recycling strategy possibly as well. We don't probably do as many margin loans or anything like that these days. That's simply probably just to do with the clientele that we're typically dealing with. And there's a lot more sort of products out there available these days if gearing is something that you're interested in as well.
So that's actually, we did have a couple of questions on that. Why don't we use that as a jumping off point for these types of questions? We did have a question, like Trent was referring to the Betashares product before, kind of like margin loans without the risk of a margin call. And we've mentioned margin calls, and Cameron did too. And actually, funny story, 2 nights ago, I went back and watched Margin Call, the movie with Simon Baker and all those. And I loved it. Obviously, a finance guy watching those types of shows, it's like finally we get our time in the sun and we look cool for once. Although, once again, immoral types of people. So painting us into a corner. But you mentioned that they're not that, common, or maybe they're going out of favor kind of thing, those margin loans. Can you tell us what a margin loan is and why there are probably other alternatives that people should consider?
Yeah, so effectively a margin loan is an amount of money that is loaned to you, okay? And then you purchase an asset with that money. There'll be an interest rate attached to that. And then effectively what you do is you can stay within a band of borrowing within that. So similar to what I guess Betashares are doing with some of their products, as you mentioned before, it's like a 30 to 40% sort of leveraged position. It's similar then, I guess, with the margin loan. You've got to stay within these bands, right? That's sort of probably the easiest and most basic way to sort of explain it. And where you hear these margin calls is basically you might go out of that band, i.e., the asset that you have in place has fallen in value by a specific amount. Therefore, you now need to actually put in additional cash to get back within that band. Okay, so that can provide, and that can be risky, right? In a volatile market where it's bouncing up and down sort of all the time. And if you don't obviously have that cash to put in, then effectively your position can be closed out, as an example as well. So obviously something that was very popular, in the 80s, 90s, noughties. It's only sort of, recently that with these additional sort of products. So one of the advantages of the Betashares one that we were talking about today is there is no margin call, right? There's no loan facility. You effectively purchase the ETF for $100 or whatever you sort of put into it, and then internally is leveraged as part of that. So if it falls in value, you don't have to tip any more money in or anything like that. So that's where, I guess, again, for a lot of our clients, a lot of them are investing for the first time, or they've only done some sort of small investing to a degree before as well. It's more of a softer entry, right? Like margin loan, I think, is something that you would probably use if you're more of a sophisticated investor or someone with quite a high sort of risk appetite as well. Plus the costs as well. Like if you look at the costs, like the interest rate that they charge and stuff like that, it's not necessarily as competitive as other options these days as well.
Well, as Cameron was saying, the interest cost on these types of investments, on any type of investment, like if anyone here went and redrew equity on their home and took $100,000 out, that's $100,000 that you're going to be paying interest on because you've taken $100,000 and added it to your mortgage. So in effect, you want to make sure that your return from your investment exceeds the interest cost as a minimum level, right? And let's not even talk about the tax and all that type of stuff either. So it doesn't matter which way you're using that. And I've found in my experience that the margin loans just aren't competitive against the other products. And to be honest, are often sold to unsuspecting investors who think it is a quick way to get enhanced exposure to whatever they're doing. So in my 2 cents, I find that. Okay, there have been a lot of good questions coming through here. So Sharish, you've asked a very general question, which is what has been the annual return of ETFs over the last 5 years? And this is a common question for most people who are new to ETFs. And the answer is it depends. There are many different ways to get exposure to different markets around the world. So what an ETF is just a basket of investments. So in this instance, this is the Diversified All Growth ETF, which we've referenced a couple times. So this ETF, Sharish, invests across the world. In one investment, it goes across the world. So you've got Australian shares, US shares, developed markets, and emerging markets. And you can see it's all mixed in there. It's just shares. So you can see that there, the different countries and so on. And finally, you can see the return. Alex, I know it's a pretty beginner type question. How would you respond to something like that?
Yeah, I think, like you said, it really depends on the ETF to begin with, what time period you're looking at as well. But effectively, if you go back sort of the last sort of 100 years or so, the US stock market has returned on average around about sort of 9 to 11% sort of within that band. So that's typically sort of what you're looking at from a stock standard ETF, which is what this is. This is not geared in any sort of way.
Yeah, there are some really good questions in here about.
Do you want to answer a question about volatility decay?
Yes,
which I know is a little bit more specific, but
yeah. So this is a question. There's been a few of these that have come through from Farhed, which said talk about the decay phenomenon, and I was just going to try and bundle all these up. Even Lemons talked about something similar. So let's talk about this. Generally speaking, tell us what it is, Alex, and then we'll just riff from there.
Yeah, all right. We'll do our best because obviously we haven't got very long, but and we'll try to keep this pretty high level to a degree as well. But effectively, when people are talking about volatility decay or volatility drag, it's sometimes referred to, is effectively say we put $100 into an ETF, right? And then it falls 5% that day, so say the next day, right? So it goes down to $95. The amount we actually have to get back to $100 is not 5%.
Mm-hmm.
Okay, it's 5.25% is effectively what we need to get back to where we were before. So when they talk about volatility decay, the reason that becomes quite important with a geared ETF or a leveraged ETF is effectively it's magnified, right? Because that loss might be magnified at 1.5 times, 2 times, 3 times, 4 times, depending on the ETF. So when the concern around that, sorry, my voice is playing up as always.
Naturally.
Yeah, I know. Is effectively if in quite a volatile market, if it falls by quite a lot, the amount then you have to get back to where you were before with a geared ETF or a leveraged ETF is going to be a lot more than say just a stock standard. Okay. Mm-hmm. However, The misnomer or the myth is that volatility decay only exists with leveraged ETFs. That is not correct. Okay, so if you think about a standard ETF, the value is basically, say, one. Okay, it's one leverage is effectively what it is. So there is still volatility decay within a standard ETF. It's just not as magnified. If you want no volatility decay, you need to put your money in cash. Cash is effectively zero. Zero is not a stock standard ETF. Does that make sense?
It does make sense. I think we love a bit of we love things like volatility and decay. It often gets pretty technical for a lot of folks with the jargon, but in effect, a lot of people do get worried that day to day, the performance of their leveraged ETFs also do change from the underlying index and how they have to recover. And obviously, there are certain types of drags that come along as well over time. So it's a lot of the times when you look at leveraged style products, correct me if I'm wrong, Alex, a lot of people think that it should be a perfect relationship. Oh, well, it says 2 times, therefore it should be 2 times. And it's not always the case because of things like we're referencing right now.
That's right. I think I saw a question before as well. That's why they often have a band as well, right? So it's not setting it exactly at 35% leverage. They've done between 30 and 40, which allows them some sort of breathing space within that rebalancing to a degree as well. So they're not having to basically rebalance constantly as part of that, because that would be worse. You actually want to have a little bit of give and take either side as part of that. There's a really good article which I can flick to you and you can put in the notes to this, which actually goes through all the maths of it, looks at the stock market from the last, or the American stock market from the last 135 years, and talks about the ideal optimum amount of leverage within that as well. So that's quite interesting.
That'd be incredible if you can send that across.
I will. But it's talked about in layman's terms as well. Like, it's quite easy to read and understand. It's drawn, from a whole bunch of mathematical articles and stuff like that, which this guy puts together quite well. So I can flick that to you. Wonderful.
Well, that's probably all we've got time for today, unless there's something that's jumping out to you from the community. I would love to direct people to the Everest Wealth website, and I've brought that up actually on another screen here, so I can bring this up. The team at Everest Wealth, you can get in contact with them at everestwealthgroup.com.au. However, there is also a link below the video that you're watching. If you want to click on the link and it says financial planning, you can get matched with a financial planner down there. So that's an easy way to do it too. Alex, it's always a pleasure to chat to you. I really do appreciate you taking time out of your morning. You could probably go just have some lunch now and enjoy the rest of your day, mate. I really appreciate it.
Thanks, mate. All right. I'll talk to you guys later. See ya.
Cheers. Thanks, Alex. Bye. That's Alex Luck from Everest Wealth. Alex is obviously a wealth of knowledge, very humble in the way he comes across as well. And that's obviously paid dividends literally for him and his team at Everest, that has grown so quickly over the last few years, because the business is doing some wonderful work. It's not always easy when you're a younger person to get financial advice. When you do find the good financial planners, you do want to jump at them. So I've got time to answer some questions for about the next 10 minutes. So you're stuck with me for the last 10 minutes. And I can see Christine's asked the question, can you explain dividends from an ETF? Why don't I get out, for those of you that remember this reference, why don't I get out Mr. Squiggle? I'll grab out my pen here in Canva. I'll bring this up here and we can get some squiggling happening. Okay, so I'm going to do this. There's not a trackpad or anything like this. This is literally just me putting some doodles on the page. Okay, so let's say, Christine, we have a company, and that company is, say, Commonwealth Bank of Australia. So I'm just going to put a C there for Commonwealth Bank of Australia. Actually, let's do the ticker symbol. C, B, well, that's a B, that's an A. Okay, this is terrible. C, B, A, right? You can give me scores for my quality of Mr. Squiggles in a minute. But CBA is it's the Commonwealth Bank of Australia. It pays a dividend of around about 4%, give or take. So if that dividend then goes back to, I'm going to do a bucket. I'm going to try and draw a bucket, right? If the CBA dividends are paid, what happens is they go back to the ETF, and the ETF collects them, right? Just like a bucket. And then the ETF will pay that back to the individual investors as what's called a distribution. So if you were here and you own CBA directly, you would receive the dividend in full, right? You would receive a dividend. The reason why we call it a distribution is because the dividend here is paid into the ETF, mixed around, and then passed back to the individual investor as a distribution. It's your share, so it's called a distribution. And the reason is that this is a company and this is a trust. So anytime you see a legal trust, a family trust, a managed fund, superannuation fund, anything like this, you'll see the word distribution. Anytime you see a company, you'll see the word dividend. They're effectively the same thing, and it's a return of income. There is one key difference over here that most people still are grasping. Normally, when you have CBA paying you a dividend, it's just income, right? Like it's like a cash dividend with some franking credits because it's an Australian company. When you get an ETF can distribute income. So we'll go I, but it can also distribute capital gains, C. So it can distribute income and capital gains that occur inside this ETF. So as the ETF runs throughout the year, it's incurring income and it's incurring capital gains, and round and round and round it goes until the end of the year, and it shoots out your share. So what the ETF providers do at the end of the year is they'll send you a statement. It comes in around about August each year. They'll send you a statement, and next to each different type of income or capital gain, this will all be shown on this statement. And you'll get these from the ETF provider like Betashares, Vanguard, so on and so forth. And then you just take that to the ATO or take that to your accountant and you're done. That's basically how it works. Now, we had some good questions. Aisha sent in a question here, which is, do you think the market is overvalued currently? I've got IVV as my core and my child DHHF, but DHHF seems undervalued. So I'm not sure if I should just wait. So this is a good question here. And basically, Aisha, the answer is no one really knows where the stock market's going to go in the short term. So what we try and do, and what some professors have tried to create, is a way to measure the value of the overall stock market. One of the most common metrics that economists use to gauge whether a stock market is cheap or expensive is to do something called the CAPE ratio, CAPE, the cyclically adjusted PE ratio, cyclically adjusted price earnings ratio. Basically, what it means is it compares the current price of the stock market as a whole to the profits of the companies over an extended period of time to try and get a sense of where it might be in kind of a long-term cycle. Now, a lot of people who use the CAPE ratio will say the stock market's always expensive, or the stock market is expensive. It's at its most expensive point. It's expensive. And they've been saying that for a very long time. And some of the reasons are that there's more money sloshing around in the system, but there's also something to be said that the companies are growing faster. So really, if people are comparing the current companies of today versus the companies of 20 years ago when the ratio was first invented, it's not always obvious that it is overvalued because times have changed and things are different. But what you can do, and what any investor can do, and what I'd highly encourage anyone to do, is to have a diversified portfolio. You don't just have US shares, you don't just have Aussie shares, you have a bit of everything. And you do keep an eye on these things, but at the end of the day, what we're looking for is we're looking to blend a portfolio so that even if the US share market falls, like it did last month, you might find other markets rise. So like emerging markets, some of the emerging market ETFs went up last month. So in 1 month, we had US shares fall, emerging markets go up, gold go up. And so you have a mix of things in your portfolio, which seems to be a better way, and is, in my opinion, a better way to build an ETF portfolio. And the problem is people don't always think like that because they think, well, stocks have gone up. The US has been one of the best stock markets, not the best necessarily, but one of the best stock markets. So we'll just put it all in that. And I would say that's pretty scary thinking. I wouldn't go all or nothing into one type of investment. So the answer to your question is it really does kind of, I guess it depends on what metric you're looking at when you gauge expensive or cheap. When you have a very, very long time horizon, so say like 20 or 30 years out into the future, what you will find is from a lot of research that supports this, what you will find is that the stock market will move probably in cadence with the corporate earnings, how well that country and the companies within it are at increasing their profits over the long term. And when I crunched the numbers on 150 years of US stock market data, I found that on average, even though the companies change in the top S&P 500, US corporates tend to increase their profits by around about 7% per annum. So that's a good yardstick in terms of, well, why does the stock market go up over the long term? Because profits keep going up. And even though the US stock market does seem a little bit expensive based on those measures, we're seeing the companies recording good results. So it keeps going up. Now, I did a podcast this morning, actually, and it was on, it was based loosely around one of the ETFs from Betashares, which is the NDQ ETF. The NDQ ETF, I was amazed at how fast it had grown over the past 5 years. And the index itself was up something like 22% over 10 years. So that's each year on average, right? Not every year went that up, some went down, whatever. But in my opinion, that's exceptional growth. And I would not bank on that happening forever. But that gives you an indication of long-term growth rates and what could and what may or may not be expensive. Okay. Gary, you've said Josh's question is good about LICs and ETFs. I'll come back to that, Gary. That will be the final one that we tackle in just a second. But I will answer Wallace's question, and I'll bring this up on the screen for anyone that may be watching on, say, Twitter or elsewhere. So Wallace asks, how are ETFs priced? I'll bring up my Mr. Squiggle again. Why not? Seeing how terrible it was before. I've got a bit of a wobbly table here too, so it doesn't help. Excuses, they say. So here we can see this ETF, and I said that CBA would be an example of something that's in here. Not only would CBA be in here, but so would Westpac. That's a W. That's a poorly drawn B, and that's a C. Westpac would be in here. Telstra would be in here. BHP would be in here, and so on. The way the basket is priced, and this is a good segue actually into our discussion of LICs. So the way the basket is priced is such that whenever you go to buy or sell the ETF, so let's say in this case, there's someone looking to buy and sell, what actually happens, that's a downwards arrow, what actually happens is every time there's a buy or a sell order created, effectively there can be a new little ETF created. So let's say it's like hitting copy and paste on your computer. If I'm going to buy an ETF and Gary's going to buy an ETF at the same time, it's not like a listed investment company where there is a limited number of shares. In the case of an ETF, what happens is a new one is created, new units are created within that ETF. And this is what we call an open-ended structure. So basically it means that as orders are placed in your brokerage account to buy an ETF, oftentimes you're not buying from another investor who's trading you their units, like his or her units. What you're actually getting is you're getting a company on the other side called a market maker. And a market maker takes Gary's order and goes, oh, great. Thanks, Gary. Gary gives him, I don't know, $2,000 for his investment. And he gets, in exchange, Gary gets units. The market maker then takes that over to Betashares and says, hey, we've got this and we've collected the shares for you. Can I, get paid or whatever? Don't worry about the market making process because it makes it quite complicated. But in a sense, what is happening is every time we are creating, the ETF is traded, there's new units being created and new units being destroyed, so to speak. And so that's what makes the ETF structure really unique. And so, okay, now you're going, well, hang on, Owen, how does this actually work in terms of pricing the ETF? Well, when the difference between an ETF and a LIC, I just said, is that one is being created, which is the ETF one. Every time, it needs to create a new one, it just creates a new unit. And every time a LIC is traded, it's only traded between investors. There's not a new one created. What actually happens is that the price of the ETF, along with all of the things inside it, is constantly basically being revalued. Because on the other side of your trade, there's a market maker going and buying all the shares that need to go inside it. So at any moment, the price, the share price of an ETF and what's inside it should be almost, you can't even notice the difference. We call that the buy-sell spread. And that's the difference between the share price and the net asset value. Let's just call it that for now. The share price and the net asset value. So this is what's inside it. That's the CBAs, the Westpacs, all the shares inside the ETF. And this is the share price you pay or you see when you log into your brokerage account. So the distance between these two things is the buy-sell spread. Now, the way the ETF market has evolved in Australia is it's become so well operated and so well established that the buy-sell spread can be like 0.03. Tiny, tiny differences between the share price and the actual value of the things inside it, which is enormous efficiency. So now let's talk about LICs and how they're different. A listed investment company is similar to an ETF, but different in a few key ways. It might seem like you're buying the same type of a thing, but it is quite different. In the first instance, it's not a trust, meaning that it doesn't have to distribute all of the income and all of the capital gains to you. It is a company, just like CBA over here. And so what happens inside this listed investment company, or LIC, is that it can hold onto the capital gains and it can hold onto the income because it is taxed, say at a flat rate of like 25 or 30%, it is taxed at a flat rate. So this whole thing is taxed, whereas in the case of an ETF, you're taxed because everything comes back to you. That's the key difference. So with a LIC, it's a holding company. It holds onto the shares like if it owns CBA or Westpac or Telstra inside of it. And you buy the shares. You trade the shares with someone else. That's why, if we bring this full circle, when you see the stock price of a LIC, right? Let's say that's the stock price. I'll switch colors. Let's say we go to Rask Australia red. That's why when you see a LIC, you'll often see something like this. You often see it looks like this, in that the net asset value, this is not always the case, but it's often the case. The net asset value is often below the share price. It's called a discount, right? Or a premium, sorry, the other way around. So oftentimes you'll see the net asset value below or above, I should say. So you get these kind of ups and downs. So it's not as efficient as an ETF. When you buy it, you're not buying the exact value or just about the exact value of the things inside it. You're buying shares. And that's basically what happens. And I shouldn't confuse us. It's normally the other way around. Normally, the share price is below the net asset value. But you get the idea. So I'll go back to Josh's question quickly. If I can find it, Gary. I didn't catch it the first time. Here we go. ETF seem to have taken over traditional LICs like Argo, AFIC, etc. Do you see value in old school LICs or listed investment style companies such as Solpats? Or do you think ETFs will continue to take over? So you might think that based on my Mr. Squiggles, therefore, I'm a little bit biased towards ETFs. And obviously, I'm paid to invest in all types of things for our investors. But I actually think both of them have their place. I think ETFs are superior in a few ways, but there are some things ETFs basically can never do. So one of the things that ETFs remember how I said before, is when there's a trade happening, I place my trade for $2,000. On the other side of my trade, there's something called a market maker. They go and collect all the CBAs and the Westpacs and all those shares, put them together and give them to Betashares or whoever, right? And in exchange, I get units. It's called a creation redemption process, right? Now, if you're thinking one step ahead, what's happening behind the scenes is that market maker needs to go and collect all the CBAs and the Westpacs and the Telstras and all that sort of stuff to put it in the ETF that I just bought. What can't happen is if that market maker is going to invest in, say, like the MCG. There's only one MCG. If I go and invest $2,000 in the MCG ETF, it's not like the market maker can go up to the MCG and pull one of the lights off the lamppost and go, here's your share of the MCG. It doesn't work that way. It has to be able to invest in something that is easily tradable under the surface. That's why you only see ETFs for things like shares, bonds, and some commodities like gold that are readily traded. You can't see an ETF that truly does something like private equity or infrastructure. Like if they say there's an infrastructure ETF, what they are actually meaning is it's not investing in the infrastructure itself, like a toll road. It's actually just investing in a company that invests in toll roads. So LICs, however, listed investment companies or companies that are like listed investment companies, to your question, Josh, a good example is Washington H. Soul Pattinson or Soul Pats. That, Josh, that is an example of a company structure that can invest in basically anything. And as an individual shareholder, you can buy into that company or that listed investment company on the stock exchange. And whatever it holds is whatever it holds. So I hope that answers your question of, do ETFs make a lot of sense? Yes. In my opinion, they'll probably capture the lion's share of people's investment dollars. That's fair to say. But do they do everything? No. Do people still want to own property? Yes. You can't get one of those in an ETF. So there's going to be room for other types of investments. But in terms of fees, ETFs are lower. In terms of efficiency and what you can actually see happening, ETFs are more transparent. And in terms of kind of what you see is what you get, it makes a lot of sense that ETFs would capture a lot of the investment dollars. But is there a time and a place for LICs? Absolutely there is. So I hope that makes some sense. So David, you said unlisted funds distribute realized capital gains as a result of their management activity. Over time, the investor sees only modest capital gains. Do ETFs have to distribute realized capital gains? ETFs have to distribute all types of things, David, including things like foreign income, all of those types of things. And that's exactly all of that is what's said on the what do you call it? On the tax statement, the tax summary that you get at the end of the year. That's all on there. So we've had a lot of good questions. You've come through with a question right at the end about NAB Equity Builder. I'll be going live later this week. We've got a few more live shows this week that we'll be running here on the Rask YouTube channel. So come back. Send me your questions. Send any of your questions. We're all here. So the team at Rask will be answering many different questions. I can see another one's come through from Drusi. What are your thoughts on the upcoming 2023 legalizing cannabis bill and its implications economically if it's to pass? I was just talking about that with our team this morning, and maybe it's a topic for another live show. But for now, ladies and gents, I do have to run. We will be back with more live shows this week, including a property one on Friday, a business one, more investing. You know where to go. We're always here. And you can take your questions over into the Rask community. That's all we have time for today. I thank you so much for coming along to today's show. On behalf of Betashares, Everest Wealth, and Alex and the team there, I really do appreciate it. So don't forget to subscribe if you haven't already, guys and gals. I'll be back probably tomorrow with more live content for you. So send your questions in, leave it in the comments. And if Alex sends me that thing, I'll pop it in the description as well. Bye for now. Have a wonderful rest of your day. Thank you.